We are about ready to hit a wall. Hey, everybody, I hope you're well. My name is JJ. You're watching Bull, Boom, Bear, Bust. Let's get into it right here. Bloomberg, fading optimism on rates signals trouble ahead for $425 billion debt wall. Folks, we're talking about corporate debt, and we see rates are going to remain higher for longer, and that's because of the data that the Fed looks at. Now, the Fed's always told us here that they're data dependent. Well, we had a stronger than expected jobs report number that just came out. Now, we're going to get into that in a little bit here in a little bit more detail. But the bottom line is the Fed is looking at this as something optimistic and something good about the economy. Look at all the jobs, is what they're saying. So now they want to keep rates higher for longer and maybe even look at more rate increases. Because remember, even the Fed came out and said that we're going to likely see job losses here in this battle against inflation. Well, just the opposite's happening. Jobs are coming in hotter than expected. So now we have more tightening ahead, likely. And that's what investors are also eyeing. Now, we've got investors also kind of skittish on a lot of other things, including a new war breaking out. And we told you right here in this channel what happens when an economic collapse begins to implode or when it begins to accelerate. We typically see war. And how is all this war possible? Well, it's possible because of debt and fake money that's conjured out of thin air and not backed by anything. It's been like that since 1971. And of course, now we've had the United States has the ability to go all over the globe. But now instead of doing that ourselves, we still have military bases in a lot of the countries, many countries. But now we're funding wars now, right? So, and how is that possible? It's possible because we can create all this debt, so we have never-ending war. Anyway, let's get back into it here. Fading optimism out of Bloomberg, about ready to hit a wall. So corporate debt, something to keep an eye out for. We already see corporate bankruptcies are the fastest that they've been since the financial crisis era, and it's likely just going to accelerate and continue to get worse from here. Well, let's talk about this. Out of Bloomberg also, the Fed will lean towards another rate hike after blowout payrolls. Now, here's the thing about the payrolls number. A lot of these are part-time jobs, and even the Hedge had a nice little write-up about this. Here's the headline. Inside today's jobs report, 885,000 full-time jobs lost, 1.2 million part-time jobs added, right? So they're looking at the jobs lost and they're looking at the jobs added. They're looking at the difference, but 1.12 million, so just over 1.1 million part-time jobs. Another thing we told you was going to happen here. More people looking to go out in the gig economy. They lose their full-time job. They have to take on 2 part-time jobs. So it's very interesting how these numbers that are really, really, not good at all can be construed as something that's positive. But that's what the Fed's looking at. They're very narrow visioned as far as the data. They look at the numbers, but a lot of times they don't look at what's behind the numbers. If you listen to the speeches that they give and what they say, they're just looking at raw numbers, raw data, and they're not really looking at the reasoning behind it. And we see that, with companies, they'll just look at numbers. And a lot of people have felt like just a number within a company, as a employee, you're just one of the numbers, right? So they're looking at the bottom line. They're looking at the profits and losses. And if they have to cut staff, they're not, concerned about people's, well-being as much as they are the bottom line. So it's a very black and white way of looking at things. And that's corporate America. And that's also the Fed. They're just looking at the numbers. And without knowing what's going into the numbers, though, I think there's going to be a lot more big mistakes that are made and a lot more miscalculations made. And it's going to lead to a lot more financial instability here, that's for sure. And I think the U.S. middle class has already spoken. And we looked at the surveys here in the last couple of weeks. We saw several surveys that said U.S. consumer sentiment is dropping and dropping fast. And also we have to look at not just part-time jobs, but what type of full-time jobs are being added. A lot of these are government jobs. From what I read, a lot of these are new IRS agents being hired, and supposedly they're being hired to go after the rich when, a lot of people doubt that. They think there's going to be more audits and coming after the middle class and your average small business, because we know that when businesses get so big, they become essential. It's kind of like the banks, right? Some of the banks that are so big, they become too big to fail. So why would they harass and audit, the too big to fail companies and banks, right? So I think they're going to be coming after the middle class and the little small business owner much, much more than they are the big mega companies. Because when you look at it, small businesses still make up a majority of jobs, even though that's been becoming more difficult for a small business. But when you look at just the magnitude of the numbers of small businesses, they still make up a bulk of the jobs. Now that's shifting. It's shifting more towards the big companies and the mega companies. But as of right now, it is still majority small business, which makes up the bulk of the economy. Now, let's talk about this. Wave of bankruptcies, corporate debt defaults could spark a downturn. That's out of Markets Insider. There's a wave of corporate defaults and bankruptcies that could be coming as high interest rates batter U.S. companies. Remember, a lot of these companies are living off of debt. I forget the exact number, but a large percentage of the companies that are in existence as of today are zombie companies, meaning they have more debt than they have profits, or they can't make enough profits to actually pay off their debt. So they're basically paying the minimums, and their balances are getting larger in some cases. We see that with a lot of households too. You sit there and make the minimum payment, and then pretty soon your 20% interest rate starts stacking up, and your debt is growing even though you're making the minimum payment. It's not a good successful strategy for paying off the debt, is making the minimum payment. That's for sure. But as long as you make your minimum payment, you'll likely still have the credit available. But there's going to be a point where we're going to see massive cuts in these credit card lines. And that's when you're really going to see Main Street become affected by this, because then you'll see layoffs accelerate even more. And they won't have even phony numbers to point at anymore, because the numbers are going to start looking so bad here pretty soon. And here's something that should tell you a whole lot about what's really happening on Main Street in the everyday person economy. CNBC recent article: even as job creation surges, Americans still think the economy stinks. And here's why: because the cost of living. People are still, for the most part, not able to get ahead. I've said this before: if you're someone that's putting away money each month, your savings is growing, and you're either out of debt, meaning your debt's paid off, or you pay it off every month, or have a small amount of debt. Maybe it's a car loan, maybe it's a mortgage. But if you have more savings than you have debt, and if that savings is growing, you're less than 5% of the population as far as the numbers that I can see here. That's pretty scary. So the goal should be, for a successful household, just like a business, you want to make more money than you spend. You want to have profits. You want to be putting money away. You want your savings to be growing. That way you have money to invest, and all kinds of things come from that, right? So, but that is a very small segment of the population. That's not good, folks. When you have most of the population going deeper in debt, or just so much debt that it's bigger than what they have saved up, right? So if you have money saved up and you don't have debt, you invest that money, uh, you're basically beating inflation right there, because you're not going deeper in debt. And with cost of living right now, most people are going deeper in debt. But if you're one of those people in the small group, the small percentage of the population, you're beating inflation because you're not having to pay higher rates on balances that you're carrying over from month to month, especially credit cards. That's just a disaster. But then on the other side, if you're able to save money and you have money to invest, you can put money in the market when a good investment opportunity comes up. I just bought more gold stocks here recently, mining companies, gold miners, and other precious metals related stocks. Also still buying precious metals as much as I can. Got another shipment of silver. About every 2 weeks now I get it. Sometimes it's once a month if I want to make a bigger purchase. But 40 more ounces I got here just a few days ago. Just continuing to stack, continuing for waiting for the next, I think, segment in our economic system, in the financial system. And after this digital currency comes out and inflation just blows people out of the water, you're going to see definitely a period of great hardship. But then after that, I think we're going to go back to sound money. Now, some people say that's never going to happen. I don't think they're looking at a long enough timeline, though, for that. But it's interesting. The people that say that's never going to happen, that we're never going to go back to a hard asset-backed currency, some of the same ones I hear saying that are the ones saying go ahead and stack silver and gold, right? So it's very strange when you're out there and listening to a lot of these different opinions here on the economy. But anyways, let's get into the next story. Listen to this here. $17.4 billion of U.S. treasuries was dumped by BRICS nations, China, Brazil, and Saudi Arabia in just 1 month. Folks, that's huge. And it's just a month, and it's only just these three countries, China, Brazil, and Saudi Arabia, dumping U.S. treasuries. So instead of buyers, now they're selling. And what's that going to cause to happen? It's going to cause yields to rise even more. We already see one of the biggest bond market implosions that we've seen in decades. Founding BRICS members, China, Brazil, along with the newcomer Saudi Arabia, quietly unloading their U.S. Treasury holdings. I haven't heard too many people talking about this. The new numbers from the Treasury Department show China's ownership of Treasury securities dropped from $835 billion at the start of July to $821 billion at the end of the month, a decline of $13.6 billion, and that was just China alone. Meanwhile, fellow BRICS member Brazil pared its treasury holdings by $2.7 billion at the same time frame. Saudi Arabia trimmed its holding from 109.2 down to 108.1, which is a decrease of 1.1 billion. What's going to happen when these other countries come on board with this alliance? We're going to see an even bigger dump in these treasuries in U.S. dollar-denominated debt. And this is going to cause the interest rate environment to definitely stay high and maybe even go higher. We're seeing what's happening with the mortgage rates. They're inching closer to 8%. For now, U.S. households are basically solvent and able to stave off the inevitable wave of home selling and putting their home on the market just because of financial strain. I think they're going to be forced to do that at some point. Not all households, but many. But here's the thing. It won't be a crash, again, like we saw in 2008, because the home ownership rate is lower today. Remember, we have more corporate, more big money owning homes today than we did back then. And that's what we mean by the home ownership rate, right? We have less homes owned by owner occupants and more homes owned by investors, big Wall Street companies, etc. And they're less likely to be forced to sell their home because of financial stress. You know what I mean? So it's going to be interesting to keep an eye on, folks. It's going to be more inflationary than I think deflationary, unless something breaks, of course, anytime at any point. This debt market could break. We could see the biggest bank failure that we've ever seen, or a combination, another set of bank failures with the too big to fails. But I think we have a lot of money being printed behind the scenes to prevent that from happening. So something would have to break on a bigger scale where the whole central bank goes down for some reason, right? So that's what would possibly cause a deflationary implosion, from my opinion. But either way, always be prepared for both scenarios. You know, be well-rounded in your strategizing financially, and be ready for anything, folks. All right, we're going to keep on top of the news here for you. Please like, subscribe if you like what we talk about here. Come back here for more updates. It really does help the channel if you just hit the like button. It gets the algorithm going and helps us stay alive. So thank you very much, everybody. Keep stacking. We'll talk to you very soon. Peace, everybody.